听见资本本期视频为您带来的是摩根大通在4月11日录制的关于全球数据的内容，主题为当巨头相争。最近全球贸易格局发生了重大变化，特别是针对中国出现了极高的关税壁垒，高到什么程度呢？可能直接冻结世界2大经济体之间的贸易往来。这可不只是新闻标题，你即将听到的这段深度讨论里，专家们非常严肃地警告，这很可能引发美国乃至全球性的经济衰退。为什么这事儿和我们每个人都息息相关？因为讨论指出，危险远不只是商品变贵那么简单，更深层的风险在于，我们日常依赖的遍布全球的复杂供应链可能会因此而被突然打断。想象一下，关键零件、重要物资突然断供，这会像多米诺骨牌一样冲击全球各地的企业和生产，影响范围可能远超你的想象。而且别以为只有一方在出牌，讨论里详细分析了中国可能采取的反制措施，这不仅仅是针锋相对的加关税，还可能包括限制关键矿产和稀土的出口，将某些外国公司列入不可靠名单进行精准打击，甚至动用汇率武器，这些都可能给全球市场带来难以预料的震动。现在最大的疑问是，这种极端紧张的局面会持续多久？政策制定者会不会很快就因为巨大的经济压力而退让？讨论中对此有激烈辩论，但一个令人警惕的观点是，即使这种极端关税只持续几周，造成的破坏也可能是显著且难以逆转的。而且就算未来关税有所回调，可能也已经跨过了引爆衰退的临界点。这不仅仅是一次关于经济预测的谈话，更像是一个警示，我们可能正在进入一个风险更高、冲突更激烈的全球新阶段。接下来是英文会议的全部内容，如果您需要我的投研助理人工加 AI 辅助校对的中文文本，您可以在频道的 Patreon 上获取。
Welcome to the JP Morgan Weekender. I'm Bruce Kasman, and with me this weekender is Joe Lupton and a special guest, Jahangir Aziz. Hey, guys.
Hey, Bruce. How's it going down in South Africa?
Yeah, I'm in Cape Town today.
Swimming with the sharks?
Jahangir, exactly. You there, Jahangir?
I'm here, and
okay,
it's nice and warm today in New York, by the way. Just ready for you to come out.
That doesn't sound like a true endorsement there, Jahangir. I wouldn't call it warm.
Well, warmish,
yeah,
sort of, given what we had for the last 2 days.
Okay, so let's stop talking about the weather. There's more important things to get into here. I think part of the way we have to kind of frame the conversation today is last week after the Liberation Day announcements, we made a material shift in our forecast to forecast a U.S. and possibly global recession. We've had obviously the market movement since then, but also the pivot, I guess I'll call it, on the part of the Trump administration, where they lowered tariffs to pretty much a standardized 10% across most of the world, but then went to very extreme tariff numbers on China. I don't know if the 145 number I have in my head is actually right, but that's probably relevant to the fact that it's already in territory that is, going to be substantially, closing off trade between the U.S. and China. So we've got that. And I guess the first point to ask is, how much, if at all, do we change our thinking about the risk to the U.S. and global expansion as a result of it? I think there's some specific things which, Jahangir, you're in best position to talk about in terms of what happens in China, what their policy responses are now, and how we think about Asia. But maybe I'll turn to you, Joe, and I'll give you the opportunity to be your pessimistic best and tell me what you're thinking about the dynamics around risk here, global expansion, U.S. economy, so on.
Yeah, I mean, the kind of irony in all of this is I feel like we're a little bit back where we started, at least in a qualitative sense, right? If you remember, our year ahead outlook had 60% tariffs on China and no actions elsewhere. In this regard, we're kind of zeroing in on that backdrop of very high tariffs on China and really not doing much in other parts of the world. Of course, magnitudes matter, and I would argue this is still a heck of a lot worse than what we thought. If you just take the 10% tariff, universal tariff, that alone, if we were just saying that, is still about I don't know, maybe 7 or maybe, I don't know, maybe 4 or 5 times worse than the first trade war. So that's a meaningful event we shouldn't lose sight of. But, we import a lot from China. So 145%, it's an average tariff rate that's actually worse than where we were at the end of the last week. I think if you do the math on this is, roughly a $960 billion tax hike. That's 3% of GDP and is certainly the worst tax hike we've seen since World War II. The question that's coming, or I guess maybe the bull story you sometimes hear is that, oh, yeah, but it's all on China and it's so prohibitive on China that it's going to knock out China. And once you do that, you're back to only a 10% average tariff rate, so it's not going to be so bad. Well, of course, that's kind of a ludicrous argument because if your hand's hurting and you cut it off, I don't think you're going to feel better about that. 13% of U.S. imports are coming from China. It's about 1.5% of GDP. The supply chain damage is going to be, very significant. And I think overall, it's just hard to not see a U.S. recession call when you add into the uncertainties that are still in place. This is by no means over. It's hard to see the EU tolerating 10% without a retaliation. Is the EU going to stay in the coalition of the compliant, or is this going to escalate as well? So with this, I've been characterizing this as just the end of the beginning, right? And this is just going to keep going. And to me, this still ends in tears with a U.S. recession and, frankly, I think a global recession. We've held on to our 60% global recession call. My gut probably leans closer to 75, but either way, I think it's still a pretty bad outcome when we end the week here.
So I just to preview, I don't think either Jahangir or I have a different view about the prospects for this being a recession in the U.S. I guess I want to kind of frame it a little differently from my perspective. I feel like what we have here is a dynamic of 3 things happening. One is the tax increase that you described. I'm not sure I'd scale it as high as you do, but I do think it's a significant tax hike in terms of what's being put on the U.S. economy. I think there is an issue here around, as you're mentioning, how much disruption do you have here as you put a tariff increase, which is less severe across countries than we thought it would be last week, but is far more severe on China. And this is one area I want to sort of get Jahangir's perspective on it. It does feel to me like you're going to have some clear disruptive effects in places where businesses are very reliant on Chinese imports. And there's clearly also some potential here for some prospects of trade in things like rare earth and others areas being shut off that do matter a lot for some parts of the U.S. Production base. But I think the other issue here, which is the one that I've been kind of more focused on this week, is as we saw something of a pivot for Trump, as we saw some sensitivity to the financial market movements, does that limit the deterioration in sentiment, which I've felt has been a pretty significant element of transmission here that is going to be, I think, needed if we're going to have a break in performance. I think you have household and businesses that can cushion fairly significant shocks if they want to, but if their sentiment is being hit, and as these cushioning forces start to erode, as you see some slippage, I think the risks of a break are greater. And I do think what's interesting about this pivot is, as you're saying it, Joe, I think that going to a more extreme on China at the same time that you take some pressure off elsewhere is not the end of things. And it is also a step which is showing a willingness to be super aggressive on China in a way that I don't think is going to make the U.S. business community feel all that good. The last point I just want to make, and this might be a good segue in terms of talking through Jahangir's perspective, is it feels to me like what the administration is doing here is putting on a tariff rate on China that they are in some ways trying to force a consolidatory posed by the Chinese as they think that they're going to cause more pain on China and then on the U.S. But I think there's 2 points here. One is I think China does have substantial forces that can be used to cushion their blow. And secondly, I'm not at all convinced that the U.S. is able to tolerate as much, if more, pain than China. And I think that's something the Chinese appreciate and are going to build into their reaction function here. So maybe, Jahangir, given what I just said, given what you're thinking, maybe give us your perspective generally, but particularly, I think, on how the Asian element of this thing plays out.
So, I know that we've been talking about, the impact across the world, and the way we have been framing it is that this is the U.S. recession and a significant slowdown, at least in the next 2 quarters, in Chinese growth. And that gets, hit on the rest, transmitted to the rest of the world through supply chain connections. Alternative way of looking at it is that the origin of the shock is actually a shock to global trade. And that leads to U.S. recession, China slowdown, and gets amplified by supply chains. The reason I'm saying that is because if you see it that way, then emerging markets, even outside of China, it's significantly affected if there is a rupture in global trade. And for all practical purposes, as you and Joe have already been talking about, that with 145% tariffs on China and 125 counter tariffs on the U.S., which is what they just announced a couple of hours ago, this is essentially will freeze U.S.-China trade. And if the two of
could I just ask you, Jahangir, to be a little more explicit, because I've been struggling with this concept. I know you've been saying this. Obviously, U.S.-China trade is going to be ruptured here, but how do you see it spilling out through the global trading system? Give me a little more color and detail on that.
Sure. So, we, keep talking about supply chain every second sentence, but when it comes to impact analysis, we almost entirely disregard it and simply look at what is the direct exposure to these countries. For example, if a country has a 10% exposure to China or 10% exposure to the U.S., we essentially calibrate the shock to that country by looking at what happens to the impact on U.S. imports or Chinese import demand for a particular given level of reduction in growth. What we keep forgetting is that if we take supply chain seriously, then much of the rest of the world trade, whether it's between EM with Europe or Europe with itself or with EM with EM, that portion, which is probably around 60-70% of the trade that we do, that is also linked to the supply chains that go through U.S. and China. So we simply can't say, I'm simply going to look at the direct effect and not look at the indirect effect. Now, I know it's very hard.
But let me, again, I want to make sure I understand this because I'm struggling with this. If you're trading between the U.S. and Europe, or you're trading between Europe and Africa or Latin America, there's obviously an effect if U.S. demand collapses. There's obviously an effect through financial conditions. There's obviously an effect if China demand shifts, or even if they're dumping low cost goods. But what happens between trade that's not running through U.S. China?
Let me put this. Wait. Actually, let me say this a second. There was an Asian Development Bank research piece that came out, and it's stale, right? So I imagine these numbers are a lot bigger now, but it's from like 2010-ish. That said that when you just look at the ASEAN countries, there's a lot of churn and trade that's going on between ASEAN countries and with China. And you tend to think, well, that's just intra-regional, so that's not going to be affected by this China to U.S. But over 30% of that trade is coming from U.S. final demand. And so it's to recognize the linkages and all the churning of trade that ultimately is being driven by a final demand.
But so let's talk about that. If you're buying capital goods from Korea or Taiwan or from Singapore, your tariff rate is 10% now. How is that distorted by or disturbed by what's happening in terms
all of the production would lead up to something happening in China? And if that final product was coming from China, if it's not the final product, then I think you're okay. But for the final products, which we know is $450 billion that's going to the U.S., that all of that is going to be disrupted. And if you are an input into that final product, that's going to be a problem. I mean, the classic example is the iPhone. right? An iPhone is going to get hit with 150%.
But in that environment, you're saying that it's still the U.S.-China trade, which is the scalable part of this. You're just saying that some of that is not going to be felt by China, but be felt by other countries that provide to the supply chain.
But let's take a specific example, right? So let's say you are Malaysia, you export a semiconductor to Korea. Korea then adds value to it and exports it back to China. China adds into a washing machine. That washing machine goes to the US. When we are computing all of these things, we are not saying that when there is a rupture of trade between US and China, we should also look at the trade between Malaysia and Korea. We are not looking at that. We are simply saying that just look at what is happening to the end demand in US and end demand in China as far as Malaysia is concerned.
Yeah, and everyone's seen like the iPhone charts, right? They're made everywhere. Germany's going to be affected. Japan's going to be affected. The US is going to be affected because they're all intermediate goods into the final assembly of the iPhone. And now you might say, oh, well, we're just going to build these iPhones elsewhere. But you know what? There isn't a kind of a Foxconn plant sitting in Iowa that's just waiting to be turned on. They don't have the manufacturing scale and sophistication that you have in China. And so you get a sudden stop in this activity and it ripples through.
And let's take another specific example. Let's look at the exports that U.S. makes to China. That's about $150 billion. Very little of that is consumer goods. Almost all of that are high-end machineries, semiconductors that are allowed by the export controls by the U.S. If that also comes to an end, then it also means that whatever China is able to do and sell elsewhere in the world also get disrupted. I mean, given the trade war since 2018, I'm guessing China is only willing to buy whatever it can't get from anywhere else from the U.S. Otherwise, China would have diverted those imports to elsewhere. They just can't do it. Therefore, they're critical for China's supply chain. So the point being that Joe and I are trying to make is that I think because we haven't taken supply chain seriously, I agree with Joe on the ADB study. It was, back in 2010. That linkage is probably, the 30% is probably scaled up to probably closer to 50% at this point in time. So if I look at the 450 of imports to the U.S. from China, the 150 of exports from the U.S. to China, that's about 600 billion. Let's say the multiplier effect of that through supply chain is just twice. So that gives you about a 1.2 trillion. That's a substantial hit to, let's say, a quarters of global trade. And I think that we are missing this angle, that if global trade goes down. Sorry, go ahead. Yeah.
So I want to kind of get into, make sure we can go through a bunch of things here. So let's sort of talk about the way China is going to respond to this. So we obviously saw that there's reciprocal tariffs today, but what are they going to do? How much are they going to cushion the blow? What's going to be?
Can I just make a point, Bruce, on that? Like before we, I think given everything that we've been saying here, that the damage is so big, it kind of feels like last week, where it's like the silver lining here is that this is such a nuclear bombshell on the global trading system that you almost have to scale it back. And I want to prepare markets, people watching for this, because in a sense, and I've been on the more negative side than most of this year, I'm expecting this to be scaled back. My baseline is we're probably going to settle somewhere in the 60 to 80% range. And Trump will try to find some face-saving way. And we haven't talked at all about the financial market weaponization that potentially could be going on, but maybe that's for a different call. But something's going to happen where this gets dialed back and is maybe going to settle somewhere around 60% and 10% elsewhere. And I don't want people, you guys, but I just want to say I don't want people to feel like, oh, everything's better as a result, because I still would think that 60 and 10 would be recession. So I just want to put that out there.
But Joe, while I agree with you that this is an untenable situation, it has to be resolved towards these much more acceptable numbers. The point is, how long will these the lack of resolution
Yeah, that's right.
And I would argue that
3 months. That is a...
Well, 3 months is, I don't think it can last that long because exactly. I think this has to be resolved in like 3 to 6 weeks.
Yeah. So, but we don't have any insight whether or not that is going to happen.
I agree.
Yeah. But going back to Bruce, your question of what is China's retaliation, I think China is going to do standard tit for tat tactics on tariffs. But that's not where. But then after a point that sort of becomes irrelevant because you're just the constraint is so binding at 100% that it's pointless going to 125s, 150s, 160s. It's just meaningless, right?
So we go thousands of percent. Everybody goes to 5 and 10,000 before we stop.
Yeah, I mean, you can throw any number at this point in time, Bruce. It doesn't really matter. What I'm looking more at is the ones that they're going to do or they can do outside of tariffs. And they've already shown their hands a bit, which is go after export controls on certain critical minerals. They can expand that. They can go after, companies that are in their unreliable list, which is the same as the sanctions list of OFAC. They can expand that, and then they can expand their antitrust investigation. They already put in DuPont in it, and they can keep doing it. In other words, they can now go specifically company by company in the U.S., and that, I think, can have a meaningful impact, maybe not at the macro level, but a meaningful impact on the companies that do business with China, and therefore on the macro level at some point in time. So that's the part that I'm looking at. And the last bit, and you've heard me say this many times, that I still believe that, CNY is a instrument of retaliation that China can use. They haven't used it. They've done a little bit this week. Yeah. Little bit this week, but they haven't done that. And that is a potent, instrument of retaliation.
What kind of risk, what kind of scale do you think they might use?
I think that supports them. I think the bigger retaliation, John Gear, is the treasury market, right? And I know this is complicated, but just to not start rolling over debt that they're holding, particularly in the long end, I mean, that is supposedly a part of the pain, which may not have been China, may have been Japan. There's all this going around, but I just think that's still lingering out there.
Yeah, now the reason I was bringing that up is because Bruce said that you are the pessimistic one, and then if I add on to this, then Bruce probably is going to have a very difficult time coming back.
That's okay, but let me go to there is the other side of this, which is how much stimulus. I think Kybin is sticking, or has at least up till now, running with fiscal credit supports that add about 1% to GDP. Are we too cautious in that at this stage?
We added a little bit more this week, right? We're talking about another trillion yuan package. That's why we get a little bit of extra growth kick in the fourth quarter in the forecast.
What's the scale of what we're expecting now in terms of support relative to GDP? I thought it's about 1%. I thought we were at 7 or 8 tenths and went up a little more to about 1% here, but maybe
So the overall fiscal deficit was 12.2, up from 11.1, 11.2 last year. So it was 1 percentage point. He's adding about 0.7 to it. So we're now to 13 point something in overall fiscal deficit. This is combining state, the federal government and the local governments. But the problem with that, as you know, is that they can push up more fiscal support, but the way in which they push up fiscal support is by pushing up production. Whether it's infrastructure spending or whether it's actual support to corporate sector, it is real GDP in China can be scaled up to reasonable levels, but it's only through production. We have seen what that.
Well, coming back to all the policy measures and the currencies you're pointing out is going to be one of them. What does that do to the rest of the region and currencies across the rest of the region? They're going down as well. Does that put pressure on central banks?
Yeah. So, but I'll come to that. But just let me finish my thought on China. That if you keep pushing production up, for the last 2 years, what that has done. It has essentially created a massive increase in inventories that has resulted in deflation domestically and export price deflation externally. So you can get 4% growth rate, 4.5% growth rate if you want to. But the cost of that is going to be the nominal GDP is going to go to twos and ones because deflation will become even worse than what it is right now. And I think that is the cost. So the question is, do the Chinese are willing to accept a hit on nominal GDP, which obviously has a hit on asset prices and profitability, et cetera, just to keep real growth up? And my sense is that even though, the numbers look okay in terms of that these are not outlandish numbers, my guess is that this time around, they are going to be a bit more cautious on simply pushing production up, given the last few years' experience.
Could you tell a story, Jahangir, just on sticking to China then? Is we've seen this sense that the Trump policies and threats to NATO and the pullback in global leadership has been a catalyst for significant changes in Europe, particularly on defense spending, infrastructure spending in Germany as well. Maybe that'll spread elsewhere. Could you also say that this is another catalyst for China to look to actually boosting its own domestic demand a bit more?
That's the big hope, Joe. This is a catalyst for them to do all the structural reforms on the housing policy, on pensions, and essentially trying to put together a structural solution to their perennial cyclical problem that they just do not have enough domestic demand. That's the hope. We haven't seen any moves in that direction. The Chinese, like every other policymakers, are looking for something that is immediate, that will boost their demand right now. And the only way they can do that, which is their, the true and tested way the Chinese have done that, is just by pushing production up, which obviously leads to more deflation.
Let me I want to just kind of switch slightly gears. I mean, the way both of you are portraying this, you would think that every other country connected to the supply chain to China and the region is going into recession. Is that the right way to interpret what you're saying?
Maybe not recession, but the damage to growth is much more than what we are actually thinking about right now by looking at only direct effects.
Yeah, I mean, I keep saying this is probably going to look like something on, in terms of magnitude, kind of the 2001 downturn. It's a very different downturn, but if I look at global GDP right now, we currently have numbers of global GDP 1.2%.
2001 wasn't a global downturn, Joe.
I know, but global GDP did fall significantly over that period.
No, it didn't.
Global GDP
not even
zero.
U.S. GDP didn't fall.
That's fine. I'm telling you, global GDP went to zero
for one quarter.
That's fine. OIA. That's fine. OIA went down to about 1%. That's
not falling, Joe. That's not falling.
Global GDP rarely falls, Bruce, and potential growth was a lot higher then. If you look relative to potential growth, you went a full year growing more than 1% below potential, right? I think there are moments in the past where we've tried to characterize global recessions, and we said it's anytime you grow below potential for a year. So I would call 2001 a global recession. This would probably
I wouldn't call 2001 a global recession.
Okay, so
I don't think that's the.
Well, let's not get hung up on words. I would say it was a year in which global GDP grew more than a percentage point below its potential. And I would think we're going to get something on the order of that, given that potential is a lot lower. Right now, we have global GDP growing, probably, about maybe 0.75 of a percentage point below potential. I would think we should probably take another 0.5 percentage point off that.
I mean, the other way to scale it, Bruce, is to say, look at, when did we have big trade shocks? So the last big trade shocks that we have was COVID. That may not be the best example, but let's look at global financial crisis, which was called.
I mean, just let me say, can I just jump in here a second? The way you guys were talking in the first 10, 15 minutes and the way Joe's putting numbers together are not consistent with each other.
Okay. How so?
No, I mean, you're talking about I mean, I think you're talking about an event which is hugely disruptive to global trade flows, is a huge tax increase on the U.S., and therefore should have meaningful and large impacts on global activity. And then you're talking about 2001, which the U.S. GDP didn't decline, global GDP slowed but didn't contract. Those two things, those two events don't align.
Let me jump in here. I think one of the things that I'm thinking is similar is because we didn't quite broaden this conversation out. I think it's going to hit China incredibly hard. I think it's going to hit the region a lot harder than what we've currently built in. I think we already have a U.S. recession call in. I think it's probably going to hit the U.S. a little bit harder than what we have written down. Europe, I think, is the place that maybe is not hit as hard. And this notion of the U.S. going down and Europe escaping, if I recall correctly, 2001, Europe was not in recession through that period, right? So
yes, it was
kind of right. So that's Bruce. That's kind of like the model I have in my mind. I know that the dynamics are very different, but
Joe, I'm sure that in the back of your mind you also have the idea that look, this is not going to last for very long. So the way in which we're scaling it is by saying that if this is a permanent shock, yes. It's close to the end of the world, the way we see that we know it. But I don't think that any one of us has that in mind. I had 3 months. Right. Joe has 6 weeks.
But I want to be clear. I've already said I don't think the 145 is tenable. I think that if you're telling me we're going to be at 145 for the next 6 months, I'm going to get a lot more negative on things. But if we get back to 60 and 10, I think we're going to get. We're going to get something like I'm trying to lay out here. But I do want to say this, and I've mentioned this in Weekenders before, that this trade after the trade is what does the recovery look like? I think we're going to struggle in the recovery just because, yes, you'll get a bounce back. But I think this new world order of completely overturning 75 years of globalization, which has lifted all boats, right? This view of switching from a positive sum game, which is what U.S. leadership in the last 75 years has delivered, to a zero sum game where, if another country is doing good, that's bad for the U.S. That's a very kind of negative take for what growth is going to look like as we look further out, in which case I think a recovery is going to be somewhat more lingering. So when I put my numbers together, we're talking about, I'm kind of building in a sense that, yes, we go down somewhat hard. We have a little bit of a bounce back, but we don't quite get back to where we were before.
Well, I'm struggling with a lot of what's being said here. I don't have any problem with the idea of talking about risk, but I think if we're talking about the disruption in the way you guys describe it, I think you've got to be careful here that you don't just turn this stuff on and turn it off. So my point would be that I think what's going on here is the U.S. is trying to exert pressure on China, thinking it can't handle the pain, and China is going to feel like the U.S. has no tolerance for pain either. And totally I think agree. if you let this thing go for a little while and you start to break things, I think the idea that then if you break things and then you reverse it quickly, you're going to end up with a smoother path and you're not going to have greater downturn, I think is a mistake. I think we may.
Yeah, I'm not saying that. I agree.
It
would be a mistake.
Well, you're kind of describing a pretty mild event overall, and you're talking in terms that don't really, in my mind.
We already have the U.S. down 0.5% this year, so I would say
that's nothing. That's not a recession.
I agree, and I said
okay. So let me make. If you agree, let me make my point, which is I think if we do let this thing go, it's not going to look like 2001 in that context, in the leg of going down. I'm also a little surprised that when we started this, I was asking about spillovers to the rest of the world, and you guys were saying it's everywhere. And now we're coming to this conversation where we're saying it's very concentrated in the Asian supply chains, and Europe can avoid this, which seems to me somewhat inconsistent.
It's a matter of scale here. I think everywhere will be felt by this. It's going to be felt more within Asia, and obviously the supply chains are much more integrated in China. Again, go back to those ADB studies that kind of look at this. So I think that's where you're getting hit the hardest. Yes, Europe is going to get hit here, and we've already lowered forecasts there. I just think they feel a little bit more removed from this. So I think this, and yeah, I think as this goes on, the shock is going to be bigger than what we've written down. When I say 2001, I'm not talking the U.S. The U.S. 2001 was an incredibly mild recession, although for the corporate sector, it was a disaster. But for GDP, it was mild. I'm just looking at global GDP numbers. And when I think of, is this going to look like the pandemic? No. Is this going to look like the GFC? No. When I go back to 2001 and I see global GDP,
I don't think it's going to look like 2001 either. If it's playing that way.
Where would you put global GDP?
I'm still struggling with this. I'm trying to figure out where I stand.
So let me go back
if we have a U.S. recession, it's not going to look like 2001, and it's certainly not going to look like 2009.
I'm not saying that. Don't put those words in my mouth. I'm not saying that. I'm talking about.
Let's go back.
But here's the tension. Then Jahangir is making the point that a global trade shock does a lot of damage to the non-U.S. And you're saying this is going to be a very mild event outside the U.S.
No, I'm not saying.
Especially if you're putting in a deeper downturn. You're putting in a deeper downturn than 2001 in the U.S. and you're saying it's going to look like 2001 globally, which means it's going to be milder elsewhere, right?
I'm saying we're going to grow more than a percentage point below potential, which is kind of, I would call a global recession. That's what I'm saying. And I think we're not there yet on our numbers. I would take another half a point off our numbers. I think that would include a deeper downturn than what we have in the U.S., which is already at minus 0.5. And I think it would be a lot more downgrades across Asia. And I might take a little bit more off Europe.
Yeah, I mean, I'm not so sure how much is a little bit of Europe. I know they have.
I mean, if you're having the U.S. and U.S. contract 1% or more, and you're having most of Asia outside of China contract, and you have China grow 2%, I don't know how you get a 1% global GDP number out of that. It's going to be much worse. It's going to be much worse than that, Joe.
Bruce, I have about a half a point. My numbers, at least that's what I'm thinking. I mean, half a point.
Half a point, what? GDP growth?
Global GDP growth, yeah.
So that's 1.5% below trend, right?
Okay. Yeah.
It's almost 2% below trend.
Yeah. Yeah, if that's what's throwing you up, then yeah, right. Maybe I was kind of underweighting it is more than I know global GDP in my mind is about 0.5%. I mean, again, this is just writing down numbers. I'm almost as lost as you are, right? So I feel where you're groping around, but I'm just trying to think of, we need to lay a baseline down so we can benchmark stuff and talk about, where we're going to be.
What I'm struggling with is not the U.S. China side and not the U.S. U.S. income hit and the dynamics around sentiment. It's how big and powerful are these supply chain issues. That's what I'm struggling with in terms of trying to understand. And obviously, Jahangir and you are both pushing hard on that front. And
and Bruce, but I would also double down on the point that you're very sensitive, which is I do think this is a much bigger shock than just trade. This is sentiment. This is the $6 trillion of household wealth that has been eliminated by my estimates. Wealth effects are going to collapse to zero or maybe even go negative after being as supportive as maybe 2-3 percentage points to consumption growth over the past year. That's a huge loss of impulse to growth. The chaos. I mean, it's not just trade; it's the chaos that's going on in D.C. It's the likelihood of getting taxed.
So let me push back a little bit against this. I'm struggling now because I'm sensitive to what you guys are saying about disruptions here, and those disruptions could end up creating an event which is far larger than what I'm certainly thinking about right now. But what I want to say to you is if I'm not putting a lot weight on that disruption, and maybe I'm wrong in that, certainly, then I also see a path where we avoid a U.S. recession. It's not my baseline, but I think you have the capacity here, especially if you're right, Joe, and you're going to pull back on the tariffs relatively soon, that you have a cushioning of household sector. You have an ability of companies to absorb things in margins. We're getting benefits here from falling energy prices. And I don't want to actually talk about that too much in an optimistic light, because I think even if you absorb these shocks in a way that you don't break, the consequences of that on margins, on household balance sheets, on more persistent inflation in the Fed doesn't leave you with a very good picture about where the U.S. economy is at the end of this year, looking into 2026. I have been thinking this is a 60-40 call, where that 40% scenario is still there'll be blood, but it's a different dynamic. But what you're pushing at me, which I'm struggling with, is whether you're basically saying this is not going to be possible because of disruptions in the global trading system.
This is the kind of is the damage done argument. I would just say this. If you get back
but no, you're saying something more specific. Let me make sure I hit this point, because I want to say what I think you guys are saying. You're saying that the action of closing U.S.-China trade like this is going to be so disruptive that if you let it run for a month or two, we're all toast.
Yeah, if you tell me we're going to run at 145 for 8 weeks, my odds of recession would go to like 90%.
No, it's not about recession, because you could have a recession anyway without it, but you're saying it's going to magnify quite dramatically through the world.
Because
it's going to be a global event.
One part that you are not bringing into the conversation, even though you had been harping on that since last year, which is that imagine what happens to business sentiment and capital spending. Well, even if you pull back to 60%, that
I'm with you on all of that, Jahangir. But the question is about whether that magnifying effect is going to be so powerful that it's going to be a dominant part of the story or not. That's what I'm hearing from you guys, and I'm struggling with in terms of how to incorporate that, how much to accept that.
What I would say is if you step back, and all I told you was at the beginning of the year you're going to have a $500 billion tax hike on consumers, which is what if you scale back to 60-10, it's about a $500 billion tax hike. So I'm going to give you that. I'm going to give you a $6 trillion. Wait, let me finish, Bruce. I'm going to give you a $6 trillion loss in household wealth. I'm going to give you some type of shock that is going to push sentiment down kind of two standard deviations below its norm. I'm going to send something through the infrastructure of the federal government that is going to give dysfunction for Veterans Affairs, for IRS, for health, for Social Security. That is starting.
Okay, Joe, you can keep piling on, but you've already got through the important things.
I'm just wondering, would you be saying we're going to have a U.S. recession in that?
I'm saying we have a 60% chance of a U.S. recession, not an 80 or 90. That's the point I'm trying to make. And what you're not incorporating in that is the fact that whatever trillion loss in household wealth comes after a 60 trillion rise that has not been fully incorporated in wealth, in spending, that the fall in energy prices.
I wouldn't push that. That's
well, let me finish what I'm going to say, and then if you want, you can jump in. That you're going to get on a 3 to 4 month basis, you're going to get a 2 percentage point real income gain coming from falling energy prices, and that the historical behavior between sentiment and hiring on the part of companies and the sentiment and the spending behavior on the part of consumers is very loose. Now, I'm not arguing against the recession call. I'm just trying to argue against the case that this is the only thing that could happen.
Add up the pluses. I would just say on the two big pluses I would push back against you, and I think they're the only two pluses you have, are the idea that, there's all this wealth that has been generated. And therefore there's this still latent wealth effect out there. I
didn't say there's a latent wealth effect. I think that
is literally what you said, and I agree. But to me, my point about balance sheets is that we don't have a lot of leverage. That's kind of helps. I think the latent wealth effect, I think that's kind of behind us at this point. The $6 trillion is going to be felt, and people are going to respond quickly to that the way they always do. So that's kind of point one. On the oil prices, Bruce, I think even you're being a little cute with that, because the reason oil prices are going down is because people think we're going into a recession.
Yeah, exactly.
Well, that's right. So if it's going down,
that's just a Cushing effect from making it a worse.
No, Joe. No. If oil prices are going down because demand is weakening, then that is that is a cushioning effect. If oil prices is going down because markets are worrying about a recession and you don't actually have that recession dynamic hitting, then it is a boost. And look at what March spending is going to do next week. Oil prices are down over the last month. What is March retail sales going to be next week? What is March IP going to be next week? It's going to be strong. I don't have our forecast in front of me. We're not actually breaking now. Oil prices are falling in anticipation of something.
Yeah.
What? But it's not.
March, I agree.
So
March
you think the economy's breaking in April? You think the economy broke? Do you think the economy broke in April?
I think we're pretty darn close to a breaking in April. Yeah.
I don't think so. But we'll see.
Think the payroll.
I think you're going to encourage front loading. I think you're going to encourage front loading of activity globally. If you're sitting as a producer around the world, you're going to want to ship things to the U.S. now in this 90-day window. I don't think this is going to break. I don't think this is breaking right now. And in that sense, the oil price drop is, for the moment, not necessarily for a sustained period, a bit of a cushion.
Yeah, but
anyway, I think we've gone on.
Even at best, that's just giving you a near-term. That's like, before the Titanic hits the iceberg here, right? I mean,
but then you're saying in 6 weeks we might not have these tariffs. I mean, there's lots of different ways.
No, we will. I said I want to stress this. If we go back to 60-10, please, listeners, don't think that's like everything.
But you don't think that lowers if you go back to 60-10 in the next 2 months, the economy's holding up well. It doesn't change the probability distribution.
I said if we're still at 145, we're at 90. So, it gets me back to 60.
Okay, that's where I am, Joe. I'm at 60. That's all I'm arguing for. You're talking as if this is all
that's
determinate.
Right now, what I'm seeing is a lot of damage, and I think we're at 75.
All right. Well, the difference between 60 and 75 observationally is insignificant because either it's going to happen or not.
I know.
So let's not argue over that. That's like a tariff of 145% or 300%. Who the heck cares at that point? But anyway, we're going to have to close this up. Jahangir, you haven't been in the back and forth here, so I'm going to let you have the last word if you want to say something.
Look, I mean, I think it all boils down to whether, even if it's for 6 weeks, I think the damage will be significant. If it's for if it's for the entire length of the 90 days, then we are in deep trouble.
Okay, on that bright note, I think we'll end here. Thanks, everybody.
And you thought Joe was pessimistic.
No, I knew exactly what I was getting when we had you come on today, so no surprises there. Okay, thanks, everybody. Well, I think we went on for a long time. Thank you, and hope we can continue the conversation next week on the weekend. Take care, everybody.